in my opinion, silver is the most underpriced asset on the planet. But even if we got to 45, 50 to 1, half of what the ratio is now, you'd be looking at what, $175 an ounce with gold at 3,500. Yeah. If you got to 50 to 1, I would think silver's going to go at least to 50 and test that. I don't think longer term 50 is going to hold. I mean, we're going to go above 50, and then who knows what kind of numbers. And gold, I mean, there is no technical area or number, because we're at all-time highs at this point, and just have to see where the next battle begins. But this is a breakout, and I view this as a worldwide vote of no confidence in paper.
Gold isn't just another asset on a chart, it's the foundation stone of confidence in the dollar. Bill Holter argues that for decades, Washington and Wall Street have worked hard to suppress its price for one simple reason. If gold were allowed to trade freely, it would expose just how fragile the dollar really is. Imagine gold at $25,000 or $50,000 an ounce. The illusion of dollar strength collapses, and suddenly the US can't keep borrowing trillions year after year. That's why every rally has been met with heavy selling. But Holter says this game is breaking down as sovereign nations dump treasuries and quietly build reserves of gold and silver. Of the two, silver stands out as the most undervalued, despite its countless industrial and technological uses, not to mention its monetary role. It trades at ratios to gold that defy history and logic. For centuries, the gold-to-silver ratio averaged 15 to 1. Today, it hovers near 85 to 1, and not long ago it spiked to 120 to 1. Holter points out that the mining ratio is closer to 10 to 1, which makes current prices look absurd. If the ratio merely corrected to 50 to 1 with gold at $3,500, silver would sit around $175 an ounce. The pressure is only building. Gold supply grows 1 to 2% a year, fiat money expands 6 to 8%. And now, more buyers are standing for physical delivery rather than settling in paper. If that trend grows, the system faces a critical failure. Paper contracts will mean nothing if the underlying metal isn't there. When confidence breaks, it breaks all at once. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Along with creating demand, not just paper demand, you're going to have more and more people buy contracts and then immediately stand for delivery. As a matter of fact, for the last 2 or 3 years now, it used to be, and I'll use silver as an example, it used to be that there were X amount of contracts standing for delivery on first notice day. And then by the time delivery day came, final notice day, the amount of contracts outstanding would have dwindled by 50% or more. Over the last 2 or 3 years, what has happened is you get X amount of contracts on first notice day, and then by the time of the last day, final notice comes, there's more contracts outstanding. And in some cases, there's more than double or triple the amount of contracts that were standing the first day. So you have buyers that have been coming in and immediately standing for delivery. And that's the Achilles heel to the fractional reserve system. I mean, there's no question. I mean, even the powers that be will admit, yes, it's a fractional reserve system. We really only have 5% or 10% of the metal or whatever it is available for delivery, because not everybody stands for delivery. Well, we're at the point now where there's more and more understanding that because it's fractional reserve in nature, it will ultimately fail to deliver. And again, the psychology of human beings, when they're told they can't have something or they might not be able to have something, they want it even more. And it's going to cause a stampede of contracts standing for delivery, and that'll be your failure to deliver, which blows up the entire system, by the way. Because if you've got all these contracts that are actually worth zero because they cannot perform, it breaks confidence. And the reason, let me back up a little bit. The reason gold, and of course silver too, silver has been suppressed because they didn't want the fuse on gold lit. And they don't want the fuse on gold lit because if you've got $25,000, $50,000, $100,000+ per ounce for gold, that shows no confidence or a lack of confidence in the paper. On the other side of that, their confidence is absolutely needed in order for the U.S. Treasury to borrow the ridiculous sums that we've been borrowing. I mean, we have to borrow $2 trillion a year just to balance the books, just to keep the system afloat. So they suppress price of gold and then whack it. I mean, you remember, go back, 10 years ago, 15, even 20, 25 years ago, gold would start to pop its head up and then whack it, 1, 2, 3%, which back then when gold was $300, $400, a $10 move in gold was huge. And it was demoralizing to see all of a sudden gold was going higher and boom, they smashed it. Well, the reason they smashed it was because they want to be able to point at the price of gold and say, see, gold bad, dollar good. And that allowed the confidence for the rest of the world to buy treasuries and fund the U.S. deficit. At this point, that's starting to unravel because you're seeing some very big sovereigns liquidating U.S. treasuries and turning around and replacing that with either gold or silver. A lot of hedge funds and family offices, they're knowledgeable. Not all of them, but a lot of them have been buying the physical metal. Now, that said, I can say that for the last 9 months, even close to a year, the demand for physical metal out of North America has collapsed. But yet the price of gold, I mean, if you asked me 5 years ago or 10 years ago, is there any way gold could be, could run from 2,700 to 3,500 and North America be a net seller? I would have said no way because, it would stir up the greed factor. But what you're seeing is liquidations out of North America and whatever. I mean, I've gotten more sell orders in the last 9 months than I had cumulatively in the last 15 years. And I asked people, why are you selling? And I've only had maybe three people tell me, well, I'm going to take a profit. And I asked them, well, where are you going to put the money in a system that's going to mathematically collapse to keep it protected? And they're like, oh, well, when gold drops or silver drops, I'll go back in and I'll rebuy it. Well, good luck with that, because when there's a failure to deliver, there won't be anything to be had. And if you're not on the bus, you're off the bus and you can't get back on the bus. But the vast majority of people that I've asked have all said, I need the money. I need it to live on. So it tells me that the money on the streets in North America is evaporating or evaporated. I mean, think about silver. Think about all the uses that silver has. Medicinal, industrial, technological, monetary. I mean, there's so many uses for silver, and it is, in my opinion, silver is the most underpriced asset on the planet.
Now, going back,
and I say that because, Danny, gold, the reality is gold is the measuring stick. We got fooled. The world got fooled for 50 years that the measuring or more, that the measuring stick was the dollar. Everything was measured against the dollar. How many dollars? The reality is dollars themselves are measured against the ultimate measuring stick, which is gold. Yeah, and the reason I say silver is the most undervalued asset on the planet, I mean, for how many hundreds of years, and even in the U.S. Constitution, the ratio is 15 or 16 to 1. You could go back 1,000. Well, first off, silver comes out of the ground just under 10 to 1 to gold. So there's roughly 10 ounces of gold pulled out of the earth for every 1 ounce of gold.
1 ounce of silver.
That's God's ratio. Right. 10 ounces of silver for every 1 ounce of gold. Now, for hundreds of years, the price ratio was 16 to 1. And the reason being, back 100, 200, 300, 500 years ago, in order to transport money, you had to transport gold or silver. But if you transported silver, you had to transport 10 times the amount of silver to get the same capital. So man discounted the silver price to 15, 16 to 1 to account for, the extra carts or carriages or whatever that you needed to transport silver. So that 15-16 ratio, 15 to 1, 16 to 1, went for hundreds of years. And in today's world, now we're back down to 85 to 1. We were as high as 120 to 1. 120 ounces of silver, that's undervalued by 12-fold. And where we are now, it's undervalued by what, 6 or 7-fold. But even if we got to 45, 50 to 1, half of what the ratio is now, you'd be looking at what, $175 an ounce with gold at 3,500.
Yeah.
If you got to 50 to 1, long term, it will move up because it's a function of how much gold can be supplied versus how many dollars are created. Well, they're creating, the money supply is growing at what, 6, 7, 8% per year. And the global gold supply is lucky if it moves 2% up in a year.
And now with
one other thing, one last thing on that, there have not been any huge gold or silver discoveries in the last 10, 15 years. So there's no big bonanza that's going to come and hit and add supply to the market.
Interesting. Yeah. So there's no big supply inflow that we're anticipating.
No, and it's inelastic anyway. Even if they found it today, let's say they found the mother lode today, there wouldn't be any new ounces out of that deposit for probably 7, 8, 10 years between permits and all the red tape. The metal will not come to market immediately. It's a very inelastic supply.
Silver looks like it's about to break free. Bill Holter says a move to $50 is nearly inevitable, and once that barrier is cleared, there's no ceiling left, only the next wave of buyers chasing higher prices. Gold is already at record highs with no technical targets left to measure against, which makes every new move a test of where sellers finally show up. What's unfolding, Holter argues, is bigger than charts. It's a global vote of no confidence in paper currencies. Metals themselves don't change. An ounce of gold today is the same ounce it was 100 years ago. What shifts is the measuring stick, paper money. In 1971, gold was fixed at $35 an ounce. Today it trades in the thousands. That's not gold becoming stronger, it's the dollar shedding about 99% of its purchasing power since the United States abandoned the gold standard. Silver tells the same story, just more violently because of its smaller market size. Holter warns the supply side is fragile. Gold, silver, and platinum above ground simply cannot cover all outstanding delivery demands. As more investors insist on physical metal instead of paper contracts, the strain grows, and markets have a psychology of their own. When people are told they can't have something, they want it even more. That's why a single failure to deliver could cascade into a systemic breakdown in days. Once confidence in paper promises disappears, the entire structure of the market risks unraveling. Let's get back to the interview.
Gold bull market.
Yeah, I think it's a breakout. Yeah, it's clearly a breakout. I would think silver's going to go at least to 50 and test that. I don't think longer term 50 is going to hold. I mean, we're going to go above 50, and then who knows what kind of numbers. And gold, I mean, there is no technical area or number because we're at all-time highs at this point, and just have to see where the next battle begins. But this is a breakout, and I view this as a worldwide vote of no confidence in paper. Metals don't change. An ounce of gold is an ounce of gold, and an ounce of silver is an ounce of silver, whether it be today, 100 years from now, or 100 years ago. It's still the same 1 ounce. What's different is the currency and how much that currency will purchase. And you're using the number 3,500 for gold. In 1971, gold was pegged at $35. So what does that tell you? It tells you the dollar since 1991 or 1971 has lost 99% of its value, of its purchasing power. I mean, this has been going on. It's been going on and on and on. I mean, we've had a bull market, if you will, in gold, but the reality is it's been a bear market. It's been a diluting market in the dollar and other currencies ever since we went off the gold standard. The dollar should be bouncing pretty hard right now. It's not. And what won't go up must go down. So I think there's another leg down. But again, I don't think the DXY is really a good index to look at because you're looking at dollars versus other paper currencies, the euro, the yen. The true measure is versus gold and silver, and that verdict is already in. Right, because gold was $20.67, and then they revalued. They took everybody's gold, and they revalued it to $35. And that, there's a lesson to be had there. When they revalued gold from $20.67 to $35, that started to break the back of deflation. It was an inflationary event. And I mean, there's all kinds of talk wherever you look now about a gold revaluation worldwide. Well, what is that telling you? It tells you that they're desperately trying to reflate the system. And they have to reflate the system because of the amount of debt that's outstanding. And it all goes back to the late great Richard Russell, inflate or die. I mean, in this system, we cannot have deflation. You cannot have deflation of assets because everything is held up on margin. And when assets deflate, you get a margin call, then the entire system comes down, and basically currencies become literally worthless because they're based on the full faith and credit of the issuer. And all of these issuers, from the United States to all the Eurozone, I mean, they're all bankrupt. They're all upside down and insolvent. Yeah, short squeezes will end in a failure to deliver. Because what happens is when you tell someone they can't have something, they want it even more. That's human nature. I mean, we're at the point now the sharks are beginning to smell blood in the water, that there's not enough platinum, there's not enough silver, there's not enough gold to meet the deliveries. And if any of these contracts fail to deliver, they'll all fail to deliver within 72 hours. And that's just human nature. Well, it spells higher prices, it spells lower currencies. But understand the thought process behind, we need much lower interest rates. Well, supposedly the economy just grew by 3%, right, last quarter?
Right.
Which I don't believe it at all. But that's a strong quarter, so why would you have to cut? The real reason they have to cut, they want interest rates lower because they've got literally trillions that are coming due to be rolled over, along with the additional 1.5 or 2 trillion per year that we have to borrow. The interest expense now is what, 1.5 trillion per year, on its way to 2, 3, 5, who knows what the number is going to be. In order to keep the interest expense down, they have to get interest rates down so that all this boondoggle of debt can be refinanced. Well, the rates were higher.
Yeah.
No question about it, because rates are, much higher than they were 2 years ago, 5 years ago, 10 years ago. So anything that's coming due, including 30-year treasuries, anything that's coming due is going to roll over at a higher rate. So that's going to add to the interest expense rather than lessen the interest expense. And that's why I'm sure they would love to have negative rates. I mean, every government on the planet loved negative rates back in 2015, 16, 17, because basically, if you think about it, they were getting paid to borrow, which is crazy. We're right at the end game. It could happen any month. It could happen in gold. It could happen in silver. I've always thought that it would happen in silver just because it's such a small market. And I mean, if you came up with 25 billion, you'd buy every single ounce produced on the planet. It's so small in relation to all other markets. I mean, it could be platinum. It doesn't have to be a metal. It could be a grain. It could be anything. Once there's a failure to deliver and people understand that, confidence is broken before their eyes, it leads to the next market and next market and the next market like a wildfire. Eventually is 72 hours. Once you have a failure to deliver, markets all over the world will not open within 72 hours. They'll all close one by one by one.
Well, then
It'll be a domino effect. And I don't think it will take more than 3 turns of the globe, 3 overnight. Oh my gosh, we can't open the market tomorrow morning. So there's another market down. There's another market down. Failure to deliver will be devastating.
So,
I mean, it will crush and destroy the entire paper system, which at that point, that's when the great taking comes into play, because you'll have market. You'll have brokers that are bankrupt. You see the failure to deliver. Markets are still open. You sell your stock. In the United States, it's T+3. It's trade +3. So you're already outside of the 72 hours before you can get your wire payment.
So essentially, not much to do.
My answer is nothing. There's nothing you can do. Once it fails to deliver, I guess the only thing you really could do is drive around town with cash. You want cash because at some point in time in that 72 hours, your credit card's not going to work. And just buy anything and everything you can possibly get your hands on that you think you're going to need for a 2 week or 2 month, or God forbid, 6+ month period of time where the system's down. You want to, I mean, this is stuff that, we've talked about this for years and years and years. Be prepared. And when we say be prepared, prepare to be on your own. Be prepared to be as self-sustaining as possible, because no one is going to help you other than yourself. And that 72-hour period we're talking about, will somebody answer the phone from 911 if the banks and brokers and everything's closed? And when I say everything's closed, I'm talking about grocery stores, gas stations, Walmarts, you name it. Nothing's going to function because everything runs on credit. And when credit stops, everything in the real world will stop as far as commerce. I would just leave people with, don't wait for that 72-hour window, because that window is not open for you to get out of the system. You need to do it now while you can do it calmly, inconspicuously. You go to the grocery store and you fill your whole cart with cans or longer term storage stuff, and people just look at you with a strange eye. Now, if day one after things start to break, you're at the grocery store, you better bring a gun, because people are going to be fighting for whatever's left. Do your preparations now while you can do them calmly, because once this begins to break, and we're in that 72-hour window, it's the precursor to Mad Max.
What makes this moment so striking is not just the climb in precious metals, but the unraveling trust that fuels it. Paper claims and accounting tricks can stretch for years, but they cannot conjure ounces that don't exist. The widening gap between real supply and financial promises is no longer a technical debate, it's a test of credibility for the entire monetary structure. As nations step away from debt-backed assets and quietly move into tangible reserves, the message is unmistakable. Faith in printed currency is eroding. Silver, long treated as an afterthought, may end up as the spark that reveals just how hollow the paper market has become. When the facade gives way, the shift won't be measured in neat increments, but in sudden repricing that rewrites the rules overnight. The pressing question is whether the next breach in confidence will be slow and managed, or whether a single failure in delivery sets off the kind of chain reaction no authority can contain. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.